Welcome to A Clean Bill of Wealth, the podcast for Canadian doctors. I am your host, Galen Nuttall. Join me as I cover concepts of utmost importance to doctors in the Great White North and interview experts in the area of finance for doctors as well as other topics. Be sure to stay tuned to the end to find out where to get your free access to the Canadian Doctors Boot Camp that I've created, as well as get in line for the next Money Mastery Challenge. And now welcome to the show. Hello everyone, this is Galen Nuttall here, Financial Security Advisor, and I'm here today with Melanie Nash. We are actually having an in-person interview at her office in Belleville at Welch. And just quickly about Melanie. Melanie is a partner here at Welch in Belleville, and she has many years of experience dealing with corporations. And I'll talk a little bit about her philosophy and approach, but first, welcome Melanie. Thanks for doing this interview.
Thank you.
Awesome. And as many of you are probably listening to this, it's follow-up from a couple of bullet points you saw in the newsletter. And in order to keep that from being too lengthy, I've decided to follow it up with an interview to kind of expand on a few of the bullet points. Before we dive in, though, Melanie and I have kind of talked about this a little bit before I hit record, that it's hard to give blanket advice that's going to suit everyone because everyone's situation is different. And so that's another reason why a conversation like this is helpful. So how is that something that you find it's hard to give sort of cut and dry advice to people in a setting of like, when should I incorporate and why?
Absolutely, because there's, as you said, there's no one scenario that's identical to another.
Yeah, absolutely. And I mean, I think what we talked about a little bit and what you provided in the article was sort of some guidelines around when it might make sense or when it's sort of some indicators of when incorporation might make sense. So we can expand on those a little bit. So first off, and I'm asking because I'm also curious, like one of the things I talk about is there's three sort of core professionals that help with incorporation. There's the accountant, the lawyer, the financial advisor, and we each know enough about each other's realm to kind of know enough, but also know when to hand off the expertise and not overstep our boundaries. So I'm also curious to hear a little bit more about what you put down there. So just to dive on in, so talking specifically, one of the big I get a lot of questions around incorporation, around the subject of when do I start my medical professional corporation. Right. And so if you want to give just like an overall idea of, maybe some general questions you get or maybe some general stages at which you're meeting people, and then we can dive into some specifics.
Well, I guess the three questions that we've outlined there, if you're making a certain level of income, it might make sense to incorporate from a tax savings point of view. Of course, that will depend on whether you need all the cash that's coming into the business or not, and whether or not you have any opportunities for splitting income, which are very strict as of our recent tax changes.
Very good. And so what we can maybe do is walk through the lifetime of a corporation. So let's say someone is a resident physician and they transition into practice. So now they have the opportunity to incorporate, right? Right. And the way that I put it is basically the money goes into the corporate. The way I think of it, and this is a client of mine whose spouse said to me, Galen, just think, and this might be a little bit too simplified, but think of the corporation as sort of a special bank account. Like you get paid into this entity or this thing, and it's very different than getting paid a salary in the sense that you have more control over how much comes out and when.
Correct. The corporation is an entity into itself, so the money is no longer yours. It's the corporation's. So in order to be paid, you have to take a salary, just like you do for any of your staff, or through dividends. So it's not really, it's no longer your money, so you therefore don't have to report it all on your personal income tax return. Right. The corporation will have its own recording and filing of tax records and expenses for those things.
Right, very good. And the thing that helped me remember that was the first time someone, and this should have been a bit of a no-brainer, but someone said corp comes from the Latin corpus, which means body. So it's like a separate body. And I was like, oh, that helps.
Separate legal entity.
Yeah, separate legal entity, right. And so one of the things, I ask people, why did you incorporate? And usually what they say is to save on taxes. But I have found that just the mere fact of incorporating doesn't necessarily mean someone's saving on taxes if they're not being strategic about it.
Absolutely.
Yeah.
If they've incorporated and they're drawing all the cash out of the company, they have to take it through salary or dividends, and they could very well be paying far more tax than they need to.
Mm-hmm. Right. So we'll dive into that a little bit. So the first bullet point is, you said if someone's making, and like you said, like you're hesitant to give blanket advice, but these are some indicators of, okay, this could make sense. So if someone's transitioning into practice and now they are making $150,000 or more net of expenses, it might be a good time to incorporate. And what about that number? I know it's not a fast and steady, like fixed number, but what about that number makes it sort of an indicator?
That's where the marginal tax rate that you're paying personally on that income would probably make sense to incorporate and incur those extra expenses that come along with corporation, like your extra tax filings and income statements and legal resolutions done each year. So.
Right, because there's a yearly cost of carrying a corporation. So the savings pretty much has to match the, or at least has to outpace the bare minimum match, but then also outpace the cost of it.
Yes.
Right. And then another thing that you pointed out, which is another indicator that I look for, is making a certain level, but also leaving something inside of the corporation. Like you're making enough such that, like you said, if all you're doing is so you're getting paid into the corporation and then you take it all out, it might not make, financial sense to incorporate because your taxes might even be higher than if you were just taking it personally, and you've got the cost of every year paying the accountant and lawyer to do all the filings and the paperwork around that, right?
Right. Part of the savings, the tax savings through a corporation is the deferral of tax. So you pay a lower rate on the corporate tax upfront. Hopefully, when you take the income out at a later date, you're in a lower income position, as in retirement.
Right, and that's another thing that I point out. I mean, not to talk too much about what I do, but it's also in the sense of yes, tax deferral, and then like how to be strategic about that. Like if I'm going to leave money inside of the corporation, what vehicles might make the most sense as far as investments go and things like that. But that's something I'll cover in a separate one. So 150,000 or more is sort of a benchmark. Actually leaving some money behind in the corporation to defer some of those taxes. Because you do, like you said, you have the ability to sort of choose, like how much do I take out this year to use personally? How much do I defer until next year?
Right.
And deferring until retirement, then having a much lower tax bracket potentially, and really making the most of it. And then the third point you mentioned was if you have a spouse and adult child that can play a role in the corporation. If you could talk a little bit about that as well.
Well, if you have spouse or adult children, and I say adult children because they do have to be over 24, if they're contributing actively to the company in a reception, scheduling, filing, then you can pay them salaries equivalent to the work they're performing. So that's a way to some income splitting, and then once either spouse is 65. You can use dividends to income split through the corporation without any active work within the company.
Got it. Okay, without active work. Okay. And so this rule changed a little bit ago. It was, like you mentioned, what are some of the big, are there any strategies that people are able to use to kind of mitigate that? Like my understanding is a couple years ago, it was not uncommon to see someone splitting the bulk of their income with a spouse, and it was fine, but now that's not fine anymore.
Absolutely, yes.
Right.
The rules changed within the last couple of years, and they're very strict now.
Mm-hmm. In the sense that they're sort of looking for, paying the spouse what's reasonable for the work that they're doing, and not more than that.
That's right.
Right.
as if you would be paying someone else. You can't pay them more
Right.
for equivalent work that
Right.
you wouldn't pay someone else.
Like if my child is filing for me a couple hours a week, I'm not going to pay them, I wouldn't pay a stranger
$30 an hour.
Yeah, I wouldn't pay a stranger $100,000 an hour to do that, so I can't do it for my child.
Right.
So, okay. And then is there any, is there any strategy, like, have there been any things that you've seen people shift around the way they do things, or any sort of strategies they've been able to do with that? Or is it really just a cut and dry, this is how it is now, and there's not a whole lot we can do about it?
Well, it's fairly recent, so we don't have any precedents yet. So we haven't seen the fallout yet. So we try to abide by the guidelines that CRA has provided, which are not set in stone. And until we see how they're interpreted, or how strict they're following these, we'll have to wait and see.
Right. Very good. And I find that to be the case where, at least in my experience, where something is put out there from a legislative side, and there's a bit of a waiting game to see how does this really shake out.
Absolutely.
A lot of changes in the last couple of years that really were, about the passive income coming out of a corporation, that changed a lot. And I find that, and I'd be interested to hear what you have to say, but certainly on my end, a lot of what I do is trying to think of a better word than hedging my bets, but I guess I just keep a really open mind about what the future may hold, and not lock someone into one path that may not continue to work in the future. And I know I'm being a little bit vague about that, but when I hear advisors say, this is what you should do, and it's always going to be this way, I find that a little bit scary, because that's the kind of thing that gets people into trouble sometimes, is following this very concrete black and white course of action.
Well, and the truth is, we don't know what it will be in the future. We don't know what the tax rates will be. We don't know what the tax legislation will be. And this has been, the last 2 years has been proof that anything can change. And the best laid plans don't always come to fruition. So.
Right. For sure. Yeah. I remember there were a couple changes about 6 years ago, and I've been an advisor for 6 years, and there's been kind of 2 or 3 kind of different things that have happened. And I remember hearing people say, oh no, well, it was grandfathered last time, so it'll be grandfathered this time. And I'd say, until you see it in writing, you don't know. Just because they did it this way before doesn't mean they're going to do it this way again. So we have to kind of, stay on top of things. That's one of the big things, and see what news is coming out, and how, like you said, how strict they're being around the fallout of the changes that they've made, or even sometimes the changes got reversed or reconsidered, and that's another factor to keep in mind.
For sure.
Very good. Well, I think that's about it. Is there anything you want to add along the lines of, if someone is? I guess one of the things I'll ask you is how we've talked about these sort of benchmark things around incorporation, but even before someone incorporates, or even if someone doesn't incorporate, they can still meet with an accountant. Like, you don't have to wait until incorporation.
Oh, absolutely. Yeah. You still could use good advice from your advisors without incorporation.
Mm-hmm. Yeah, because I talked to some of the residents I work with, and talking about, tuition credits and things like that. And I'm a big believer of, I personally don't do my own taxes, because it's something I do. If I were to do it, I would do it once a year. I might make a little mistake that would more than, the mistake might cost me way more than it would have cost for me to pay a professional to do it. So certainly I'm a big believer in that. Anything else you want to add to the discussion around specifically to residents or physicians?
No, I think we've covered most of it. Well, just to generate information and for everyone to seek out help, because no one's situation is the same.
Yeah, absolutely. And there are things, I mentioned it before we hit recording, but before I became an advisor, I remember I would go and I would sit in my dentist office waiting room, and I would pick up a magazine that was about finance, and I would read an article thinking, oh, this is the next thing I should do. And then a week later, I'd be, let's say, in my doctor's office, and I'd pick up the next edition of the same magazine, and all of a sudden there's a different thing I think I should be doing.
Which is contradictory to the first.
Right, which felt oftentimes contradictory. And it wasn't until I became an advisor that I even understood, okay, what is the big picture? Like, I'm a big fan of looking at the big picture and the long term, like not just what has worked in the last month or two, but what has worked for a long time, and the bit long future picture of what's most likely to work for the long term, and hedging against the changes that can happen. Perfect. And so, where can people best get in touch with you if they want to know more about getting their taxes in order?
On probably best by email.
Okay.
Nash at Welch with a ch.on.ca.
Perfect. And also they can check out the website, Welch LLP.com.
LLP.com.
Perfect. All right. Thanks so much, Melanie.
Thank
I really
you.
appreciate it.
Thanks.
Thanks for having joined me on this episode of A Clean Bill of Wealth. Be sure to go to GalenHelpsDocs.com to get access to your free financial bootcamp for Canadian doctors. That's GalenHelpsDocs.com, GalenHelpsDocs.com to get your free access to the Canadian Doctors Financial Bootcamp and be in line for the next Money Mastery Challenge that I'm holding. Take care and talk soon.